A recession. Yes, a recession is coming. And what can you do to make sure you come through the other side richer than before? Find out right here, right now on Barry Charles. Welcome to the channel. Remember to like and subscribe and share this video all around the world. Let's have a look at recession, what we can do to make some money so we in the long term are better off. Yes, obviously the issues at the moment in the real estate market is the interest rate just keeps going up and up and up, and the prices haven't necessarily gone down enough. But expect a big downfall in the real estate market. It's already here, but if it could really drop down, doesn't matter where you are in the world. There are some places obviously that just keep skyrocketing, but in a lot of places it is on the downtrend, and when it really drops, that's the time to buy. Now obviously you have to worry about interest rates. You've got to be able to afford it, but the thing with the interest rates so high, just do it for short term and realize that the interest rates will just come down eventually within the next year or two, because they're forced to. The governments, especially in the US, will be forced in Australia and anywhere around the world, wherever you are, boom, down. That's the time to refinance and go from the high interest rate to a much lower interest rate. And the people that already got low interest rates now, good on you. They can get long-term ones at ridiculously low interest rates. That was the perfect time at that stage. But for the people now that are looking to invest into new stuff or investing for the first time, yes, wait for the prices to go down a bit more and get a bargain that way, which means long term you will have more capital gains. So if you can get a house for 100k under what it's worth, then there's 100k in your back pocket. If it's 200k and vice versa, it keeps going up and up and up. So if you can find that bargain out there, that is one way to invest. If we look at the stock market in terms of recession, well, at the moment the banks are going down, so banks are a possibility of being on a bargain. Doesn't mean they're going to make you tons of money, but if the big banks like the Wells Fargo's and the Bank of America's, they go down quite a bit. If they go down 50%, whether they ever get that low, but if they go down quite low, it's a good time to buy them if you're wanting a solid company going forward. What's the issues in the banks at the moment is over lending, giving out easy mortgages, as well as credit card debt. That's been a big issue lately. Obviously giving out credit card debt to people that have no money, and they spend all their money, and then they get about 5-10 credit cards, and next month they're 50,000, 70,000 in debt. And if you add that up for like about 10 people, there's 500,000. 20 people, it's $1 million, and just skyrockets from there. So that is the problem with the thing. But if we're going back to invest, where should you invest at the moment? Well, if commodities go down more, there could be a good chance to invest in them. Don't forget, commodities aren't really big winners either with the banks, and the big winners are the growth stocks. That's where you can make the biggest money, but it's also the biggest risk, because the company may never get to profitability and they crash and burn. So yes, you got to do your research on growth stocks, but that's definitely one way to definitely make some big money. If you're more on the safe side, you go into value investing, dividend investing, where you look for companies that might pay a decent dividend. Most of them are only paying about 2%, 1%. There are ones that pay 5% that are okay, but you're not going to get much appreciation growth of the stock. So that's what you got to realize. You're really only buying it for the dividend, not the appreciation in the stock. So if you're looking at 5%, you're looking at 20 years to get your money back. So is that a great investment? Yes, no, maybe so. That's what you have to think about when it comes to doing dividend investing. If I'm looking at the future, but yeah, for me, if you really want to make big money in the stock market, super duper money, it's in the growth stocks. But yes, as a lot of people say, risk versus reward here, because your stock could crash to the moon. But there's stocks that are decent already that are still growing. So Tesla is an example of that, although I think the share price is overvalued at the moment, but they are still growing. They're not going backwards, they're growing. You just got to see like where their prices to where their growth is it actually matching Sometimes you can get a stock that was undervalued, like Facebook, for instance. It just had all this bad press, and it went right down to $80. If you got it at that price, like myself, well done. Obviously, a lot of people will say, "Oh yes, we bought Facebook at $80 and doubled, or getting close to nearly tripled now." But what they don't tell you is that they invested at $400 as well. They won't tell you that, but from Facebook, for me, when I first brought in, I brought in when the dip was happening at around $300. And obviously when you buy a bit at $300 and then it starts going lower and lower and lower, you just keep buying the dip, and then it just keep going down, down, down. And your cost average is going down as well. But it's always good to have a lump sum of money. Always have a lump sum of money there. That's a good thing I think you need to look at. There's emergency fund, yes, but there's also an emergency fund for investments. It's something that's not talked about a lot. If you have an emergency fund for investments, whether that's real estate or going into the invest market, this is when you can really make some money. If you can save 10k, 20k, 30k, for the people up higher, 100k, million. I mean, it doesn't matter where you are. If you have a certain amount of money, you can just ready for a big lump sum when a stock is an absolutely bargain. Like Facebook is a great example. Boom, when you put it in, you're making real money. Now the question is, where do you go from there? Now there's 2 ways around it. Long-term invest, you just leave it in there, keep it going. Which is, yes, it's a knife-edged sword here. So yes, you can take the money out, but you're paying that interest on getting that money out, especially if it's before a year. And you're going to pay on capital gains regardless. So if you don't pay the capital gains, it just sits there beautiful. So that's why I just leave it in there. But you can make more money by letting it go. Like if you think, yes, it's made this much profit, that's what a lot of people do. Then they sell out of that, or sell some of it, say their profit share. If they double their money, they sell half their shares. Boom. And then they go and put it into another investment that they think is going to grow. Now that's the way you can keep making money, but you've got to make sure you have enough money to pay the tax on all that. That's the only question with that sort of strategy. You've got to keep paying tax. And it might not be worth the benefit of changing, but if you're making 100% every time, then it's definitely worth it. But if you're only making 20%, then sometimes you might be losing out on tax if you invested the wrong time, and that can happen easily with stocks. Look, if you were in the bank sector lately, you will be getting screwed, especially in those riskier banks. So if you're at $100 in First Republic and now it's dropped down to $11 or even less, that's where the problem is with going for. So that just gives you a few tips on what you can do in investing in a recession type thing. I hope you got enough out of this video. And I will be back soon with another video here at Barry Charles. Remember to like, subscribe to the channel, and share this video all around the world. Have a lovely day out there.